Good morning, and welcome to the March 2025 meeting of the SEC's Investor Advisory Committee. I am Brian Shore, and I chair the committee. Before we get started, I'd like to turn the microphone over to Andrew, who will conduct a roll call.
Thank you, Brian. Good morning, everyone. I will now call the roll. James Andrus.
Present.
Christina Martin Fervita.
Present.
Gina Gale Fletcher.
Present.
George Georgiev. Not present. Colleen Honigsberg.
Present.
Craig Kanoki.
Present.
Christine Lazaro.
Here.
Nancy Limon.
Present.
Amy McGarity.
Here.
Andrew Park.
Present.
Dr. David Royney. Not present. Paul Roy.
Present.
Brian Shore.
Present.
Jennifer Schultz.
Present.
Andrea Sight.
Here.
Alvin Velasquez.
Good morning.
Thank you, Brian.
Thank you, Andrew. Today's meeting features an engaging agenda with two timely panel discussions along with one recommendation. Our morning panel, beginning shortly, will be moderated by Alvin Velasquez. Alvin is the vice chair of our disclosure subcommittee, and he's also an associate professor of law at the Indiana University Morris School of Law. The panel will examine the disclosure of artificial intelligence impact on operations. Artificial intelligence poses a variety of risks and opportunities that companies need to disclose, but there's significant inconsistency in those disclosures, which makes it difficult for investors seeking clear and comparable information. A recent report on the Harvard Law School Forum of Corporate Governance highlights that over 60% of S&P 500 companies view AI as a material risk, with concerns spanning across cybersecurity, competition, innovation, regulation, intellectual property, ethical, and reputational risks. However, the way that these risks are disclosed varies significantly among industries, making it challenging for investors to assess and compare the risks and opportunities effectively. Our panel is going to examine how the SEC can harmonize AI-related disclosure regimes and help provide information that investors are seeking. To do that, the panel will specifically focus on AI's impact on corporate operations and financial disclosures. We'll break for an administrative session after that at 12:20 to 1:45 p.m., followed by remarks from Acting Chairman Ueda from 1:45 to 2 p.m. Thereafter, we'll have our afternoon panel on retail investor fraud in America, which will begin at 2 o'clock, and that session will be moderated by Andrea Sight, chair of our IAC Investor as Owner Subcommittee and the Ohio's Security Commissioner. In that panel, we have retail investor fraud impacts the lives and financial prosperity of individuals and families across America. Nearly 1 in 10 investors lose money in fraud during their lifetime with little or no opportunity for recovery in many cases. This panel is going to examine the economic impact and the mechanics of retail investor fraud in America and explain how bad actors, including large criminal organizations, as well as small scammers and individual scammers, are taking advantage of Americans. And how artificial intelligence and other technologies are being used to steal wealth at an astonishing pace. We're going to have a wide array of panelists on that panel: securities regulators, fraud experts, who will be discussing their work combating these schemes, and conclude with a moderated panel discussion addressing questions from the IAC. Following the afternoon panel, the members of the IAC will facilitate a discussion regarding a recommendation on preserving an investor's ability to bring a claim under Section 11 of the Securities Act of 1933. I look forward to our robust discussions and to our recommendation as well. We now turn to the opening remarks from our commissioners, Commissioner Peirce and Commissioner Crenshaw. First, I will call on Commissioner Peirce for her opening remarks.
Thanks, Brian, and thanks to all of you for being here today and for our panelists as well. Appreciate your continued work. I know this is going to be a busy day, and really looking forward to watching it virtually after the fact. I think there'll be some really good discussion. Although the commission's makeup has changed and we're seeing changed commission priorities, our shared desire to ensure vibrant capital markets and informed investors will continue to unite and guide us. Today's first panel, as you've heard, is set to discuss how public companies disclose the risks and opportunities associated with artificial intelligence. I hope that one theme in this conversation will be the value of principles-based disclosure and the value of affording companies the discretion to make disclosures based on what's material in their particular circumstances. Principles-based disclosure rules do not prescribe corporate disclosure, but instead provide the framework within which companies make material disclosures to investors. Attempts to fill disclosure rulebooks with requirements specific to climate, artificial intelligence, or any other hot topic disserve investors in several ways. First, companies that do not have material things to say about these topics can be forced to spend company time and resources saying them. Second, even mere disclosure requirements can end up being an indirect way for a securities regulator to micromanage substantive company operations. Third, these disclosure requirements can distract corporate boards and managers from doing more important things. And fourth, corporate disclosures filled with answers to prescriptive disclosure frameworks drown out material information. Clear and comprehensive disclosure should be our goal, not homogenization for its own sake. Today's second panel will discuss retail investor fraud. Artificial intelligence is a little bit of the theme here also. This technology, like any other, can improve lives, but it can also, in the hands of bad actors, devastate lives. Our response to the now higher tech fraud menace will require creative thinking and a commitment to pursuing cross-agency coordination at all levels of government. The Commission has taken an important step in facilitating this effort through its Interagency Securities Council, led by Adam Anasich and Manuel Vasquez. The ISC brings together financial regulators and law enforcement to discuss emerging threats, hear from investigators conducting and supervising investigations, and explore case study examples of agencies employing innovative approaches to combat financial fraud. I look forward to hearing from Andrea and the other experts on the panel that she's assembled. The committee also will consider a draft recommendation aimed at ensuring that investors retain their ability to bring claims under Section 11 following an initial offering by establishing a required lockup period. In other words, the committee may be asking us, pardon the pun, to pick up the slack after the Supreme Court affirmed the tracing requirement in Section 11 of the Securities Act. The draft recommendation notes that the recent changes to the IPO process have diminished plaintiffs' ability to pursue claims under Section 11 by, quote, tainting the pool of registered shares and thus impeding traceability. How widespread are these changes? For example, although the problem may be broader than direct listings, there were only 11 of those from 2021 through 2023. Given that many companies going public want to raise capital, why should we expect that there's going to be an uptick in direct listings? Additionally, while early lockup releases may be on the rise, they're often bespoke, and in at least some instances, they might accord with the draft recommendation. Would the draft recommendation, if implemented, even change behavior? Shouldn't we protect underwriters' ability to waive a lockup in appropriate circumstances? How large of a problem would this recommendation solve, and should the Commission expend its limited resources solving that problem? Does the availability of private rights of action under Section 10b mitigate this problem? Given the strict liability standard of Section 11, might attempts to expand its reach do more harm than good for investors, given the costs and distraction that companies will bear with Section 11 litigation? Let me conclude by thanking you, Brian, and the other members of the committee and today's panelists for their dedication, as well as Christina, Mark, Andrew, and Adam, who have worked with the committee and to put together today's meeting. I look forward to the discussions. Thank you.
Thank you, Commissioner Peirce. Next will be Commissioner Crenshaw.
Thanks, Brian. Good morning and welcome, everyone. It's always gratifying to come to these committee meetings and see the lively exchange of ideas in the name of investor protection. It's an incredibly important mission. And as always, I am so very appreciative of your participation and the hard work leading up to the meeting today. Today's session should be really interesting. The first panel, as you've heard, is focused on AI disclosures. AI is advancing at a breakneck pace. It brings both tremendous opportunity and risks to the market. But not just to the market, to issuers and investors as well. So this is an area where I think my colleagues and I hopefully agree. We need to figure out how to make sure that the rules of the road are evergreen and sufficiently robust to keep up with the pace of the change and protect investors. This begs some questions. How can we do that? Should we make changes to our disclosure regime? Are there ways to better standardize disclosures so that investors receive information that's consistent, complete, and not misleading? How should we message to companies that they cannot simply tout the benefits of AI without adequately explaining how AI models are being developed, deployed, and measured over time? And what are the ancillary risks? When businesses talk about AI, are they uniform in their definitions? On this last question, I met with many market participants when we were considering rulemaking around the Digital Engagement Practices rule. I asked companies how they're using AI, and almost every single company employed a different definition of AI in their response. Maybe one of our biggest challenges is just being on the same page about what we're talking about with respect to AI technology. And here we may need to spend more time at the starting line before we race to the finish line. I do want to thank Professor Velasquez for putting together a panel of diverse and thoughtful perspectives on this subject. You are thought leaders, and I am deeply interested in your discussion. As you all may know as well, the agency is hosting a roundtable on artificial intelligence on May 27th. And I hope you will consider lending some of your voices on these topics to that event as well. I think there'll be both an opportunity to attend and submit comments. Our afternoon panel is titled Retail Investor Fraud in America, and I think it follows nicely from the morning session. AI and new technologies open many doors, but not only those with benevolent passages. I think we'll hear from our afternoon panel about how these technologies also create opportunities for fraud and financial harm. I can't underscore enough the importance of this subject. Fraud pays. Billions of dollars are lost by hardworking Americans every year to scammers. I think about our agency actions every time with this backdrop. Now, I think it's fair to say we're in a moment of deregulation at the SEC and overall. I don't know what that new approach will hold and what a new budget will look like, but with the specter of government funding cuts looming large, I think we need to think about this. And I think we have two opposing forces at play. On the one hand, technology advances may amplify retail fraud, among other financial crimes. On the other hand, our ability to deploy agency resources and regulatory tools may decline. I ask you all, how can we continue to best protect investors in this environment? Here too, the panel and its moderator, Commissioner Andrea Seidt, have my deep gratitude for their ongoing work in the furtherance of investor protection, in addition to their contributions today. Finally, the committee will consider today a recommendation about a central shareholder right, the ability of investors to seek remedy when the disclosures relied on to purchase, sell, and value securities are untruthful. Section 11 of the Exchange Act creates an investor right of action that imposes liability for misstatements in reporting company registration statements. This framework incentivizes truthful and accurate disclosures. It helps keep issuers honest. Indeed, Section 11 serves as an assurance that if a disclosure is not reliable, a remedy is available to the people who relied on that disclosure. This in turn facilitates capital formation. It means that investors can have more confidence in issuer disclosures. They can make better informed decisions about how to invest their money, or in the cases of financial advisors, their clients' money. I look forward to the recommendation ensuring this important right is maintained. Thank you to everyone here. Thank you to the staff of the agency and the Investor Advisory Committee, for our IT folks who help put on these incredibly important events that help in markets, that help investors, that help capital formation. Without the staff, none of this would be possible. So my deep, deep, deep gratitude to them for all of their hard work as well. Thank you.
Thank you, Commissioners Peirce and Crenshaw. I want to note for the record, George Georgiev has joined us as well. And let's turn to the next item on our agenda, which is the approval of our minutes from our December 10, 2024 meeting, which have been circulated prior to this meeting. Do I have a motion to approve the December minutes? Thank you.
So moved.
Okay. Can I get a second?
Second.
Thank you. All in favor?
Aye.
Aye.
As you've heard, we're going to have a panel on disclosure of artificial intelligence's impact on operations. It's going to be moderated by Professor Alvin Velasquez, who's Vice Chair of our Disclosure Committee. Alvin, if you'd like to take it from here.
Sounds good. So thank you and good morning. First and foremost, the efforts of this panel are not mine alone. They're the product of a lot of work, not just by the panelists, but also by my colleagues, James Andrews and Craig Kanaki and Christine Lazaro and Brian. So thank you all for helping us, and George Eve. So thank you for keeping us on track here and making this a reality, especially so soon into my own tenure. The point of this panel is to develop a recommendation as far as artificial intelligence and disclosures and bring a sense of coherence across the market. And what really kind of served as the motivation, as Brian read, was the fact that that the disclosures are uneven, and of course they're going to be industry specific, but we need information about what investors actually want and could use. And one of the important things that I want to highlight here during today's conversation is getting a clear definition of just what is AI, because we use different definitions to mean different things. For example, a lot of times in the employment space, we're talking about algorithmic management, decisions that are made, by example, through an algorithm that doesn't use a large language learning model. How do we get definitional preciseness is going to be something that is the aim of this panel, amongst other things, as well as trying to get categories that make sense. With that, I am extremely pleased to be joined by our esteemed panel, and I'll go through introductions very quickly. First, their bios are all publicly available, and so I just wanted to make a couple highlights. The first is we have Matt Bodie. Professor Matt Bodie is a Robbins Kaplan Professor of Law at the University of Minnesota School of Law, where he teaches and writes on labor and employment law, corporate law, data privacy, and algorithmic management. He's published over 50 book chapters and articles in journals such as the Georgetown Law Review, the Notre Dame Law Review, the Vanderbilt Law Review, and Virginia Law Review. Along with Grant Hayden, he's the author of Reconstructing the Corporation, From Shareholder Primacy to Shared Governance. And he also served as a reporter for the ALI's Restatement of Employment Law, focusing on privacy and autonomy. He served as a law clerk to Judge Blaine Michael of the U.S. Court of Appeals for the Fourth Circuit, and has a J.D. magna cum laude from Harvard and an LLM from NYU School of Law. We'll then be joined by Deep Ratna Srivastava. I'm going to make sure I get the name right. Srivastava, thank you, who's the Chief Artificial Intelligence Officer at Franklin Templeton. He's a Senior Vice President, Head of AI and Digital Transformation. He's responsible for the strategy and execution of Franklin Templeton's AI and digital capacities. He holds a certificate in quantitative finance from the CQF Institute. He's also a GE Capital certified Six Sigma Black Belt and IBM certified in Python for data science and SQL, if you're looking at it, the bios, say it's SQL. Mr. Srivastava is also the co-author of A New Approach to Goals-Based Wealth Management, which was published in the Journal of Investment Management and won the Markowitz Award in 2018. And he's also co-authored several papers in published journals such as the Journal of Banking and Finance, Computational Management Science, and Journal of Wealth Management. He's on the editorial board of the CDO magazine and the advisory committee of the SFO Chief Data Officers Community, managed by Evanta, Global Business of Data Advisory Board for 2023. We'll then be joined by Hamish McAllister. and Hamish is the CEO of Transparently AI. He has 30 years of experience in finance and doctoral research, and afterwards formed the foundation for Transparently AI. Hamish's experience and research informed the basis for his company. He has over 30 years of experience in finance at organizations. His diverse background includes market strategy, quant strategist, portfolio manager, equity analyst, and treasury analyst. This experience has sparked his work, and he has completed projects in partnership with both private and public entities, and is a technical advisor for fintech products. He has also held non-executive directorships with companies in the transportation, property, and distribution industries. He has a PhD in finance and a master's in economics and a bachelor's in accounting. We'll also be joined with Rekha Vaitla, who comes from the investment office for CalSTRS, a sustainable investment and stewardship strategies. She previously served as the Director of Portfolio and Risk Management Analytics for the Illinois State Treasurer's Office. And finally, we'll be joined by Paul Washington, President and CEO for the Society for Corporate Governance. Paul Washington, founded in 1946, the Society is a not-for-profit organization with 3,700 members dedicated to enhancing corporate governance. Prior to becoming the Society's president in April 2024, Paul led the Conference Board ESG Center, the premier U.S.-based nonprofit think tank addressing corporate governance, sustainability, and citizenship. Before the ESG Center, Paul served for 2 decades as an executive at Time Warner, including as Senior Vice President, Deputy General Counsel, and Corporate Secretary, and in that role was responsible not only for the company's corporate governance, but an array of legal issues including antitrust, intellectual property, and regulatory and international law. Before then, he was at Sidley & Austin and served as President and Corporate Secretary of the Dime Savings Bank of New York. And he graduated from Yale College and Fordham Law School. So, as you can tell, a very, very qualified panel to take on the topics we have before us today. And so with that, let me turn it over to our first panelist, Matt Bodie.
All right. Thanks so much to Professor Velasquez for this invitation. Thanks to Chairman Shore and the Investor Advisory Committee, and also to the SEC more broadly, Commissioners Person, Crenshaw. It's really an honor to be presenting here. I wanted to acknowledge the research assistants of Yesenia Gutierrez and Caleb Bois, 2 very talented University of Minnesota law students. And also acknowledge the work of Professor Fletcher and Professor Georgiev, who are both on the committee, whose work is, I think, very informative for a lot of what I'm discussing here. So thanks to them. All right. So I am going to begin by talking a little bit about AI, and I do have a set of slides. Just wanted to, okay, there we go. All right. All right. So next slide, please. Obviously, one of the things we've been talking about already, we've gotten into this question about what is artificial intelligence. And to some extent, right, just the basics of computing enhance our ability to do things like a calculator enhances our ability to compute, right? So that's immediately something that some people might attribute a kind of artificially enhanced intelligence to. But that's not generally what we've meant by artificial intelligence. Most recently, as Professor Velasquez alluded to, machine learning and algorithms have been seen as an artificial intelligence model, right? Something where there is the possibility for learning, the possibility for feeding data, the possibility of moving into what's often referred to as the black box aspect of AI, which is we don't exactly know exactly how it's coming up with its decisions. It has learned through kind of the model that we've created within it and is building on that in ways that we can't, connect the dots. Generative AI is probably what most people think of these days as AI, particularly the large language models and the image generators, just in the last couple of years. And again, we saw the explosion with ChatGPT-4, really kind of, I think, introducing this idea into the marketplace of ideas, the marketplace of activity. I know that my children are using this for writing things like emails and things like that. So, and I also have my colleague Dan Schwartz at University of Minnesota has written a number of papers about how lawyers can use generative AI to enhance their ability to serve their clients, and also even students can use it in positive ways to help kind of frame arguments. So this is probably why a lot of companies are thinking about AI because of this explosion in generative AI. We don't yet really have to worry about artificial general intelligence, although I think a small number of folks might say we're there, but I think most experts would say we have a ways to go. Some experts say we'll never get there, and then there's something called superintelligence, which sounds like something out of science fiction, but is probably has like the biggest upside and the biggest downside for humanity as a whole. Next slide, please. All right, so this is from a Deloitte report about generative AI, and just focusing on the different modalities that are available and what those modalities can bring to companies in terms of positive upsides, right? So cost reduction, process efficiency, growth, we think of those things, but also just the ability to generate a positive set of new opportunities. One paper referred to it as almost like a superpower, right? That we should think of AI as like a superpower that humanity can employ for good, but also we know there are supervillains as well. So that's a possibility as well. Next slide, please. So in terms of companies and thinking about AI, right? 2025 McKinsey report just recently released. Almost, 92%, 9 out of 10 companies plan to invest in AI more over the next 3 years. But not even half of the C-suite respondents said that their company is developing AI fast enough, right? So this is something where there's a lot of sense that perhaps there's more we can do, right? The director survey it showed a similar sense of opportunity, but also concern about missing potential efficiency opportunities, missing potential opportunities to grow, right? About 2/3 of directors surveyed believe that their management team has the skills to execute on AI and generative AI generally, but only half think they have sufficient information to really calculate the risk as in their role as a director on the board. Next slide, please. In terms of potentially material AI risks, right? I think effectiveness is a big one because of that black box aspect of AI. It is sometimes hard to know how effective AI is, and so it's hard to rely on AI. We've heard a lot about AI hallucinations, and one thing that AI can lead to is overconfidence if we see it work a few times and then we might think, well, okay, it's worked a few times anecdotally for me personally, and then I can assume that this will work. Even if there is if it works 99 out of 100 times, right? What is the consequence of it not working that 100th time, and then how does it compare with how a human would proceed with the same tasks? Systemic over-reliance across sectors, right? Particularly if there's a small number of companies that can manage a large generative AI language model or image generator. If we rely too much on a small set of companies and there are systemic problems within those frameworks, we've certainly seen this before. We could have that again. AI washing, right? Over-claiming about AI is a problem. Just as a lot of boards feel like they're not doing enough, some people might put out, or some companies might over-claim the extent to which they're invested in AI, leading investors astray. Cybersecurity is more of a concern when you are dependent on AI. You are more dependent on your data and your data sources and the reliability of your data testing, resources more generally, which I'll talk about more in a little bit, legal risks, and then the impact on the workforce. So these are all kind of big types of risks that AI can generate. Next slide, please. All right. In terms of finance in particular, anytime you have a group of companies relying on the same set of tools to make decisions, if there is systemic over-reliance on those tools and those tools go astray, that can lead to catastrophic results. I have a list of some of those right? The long-term capital management team relied too much on this idea that interest rates and country currencies would kind of rise and fall together, or that they would be independent, that they would not rise and fall together, but that ended up not being the case, leading to that bailout. We've seen this in the 2008 financial crisis, the flash crash. Even the DeepSeek announcement recently led to a big drop when investors were surprised at the ability of the Chinese company's model to work relatively effectively compared to the investment in that model, right? So we see it not just with regard to investment, but also using that particular tool could lead to a real set of volatility that might not otherwise be there if people were acting more independently. Next slide, please. Right. I just wanted to mention the Babina and co-authors article about this systemic risk. They found that there is an increase in systemic risk the more firms invest in AI, and that as this investment grows and as companies kind of dive into these opportunities, risks change from idiosyncratic to systematic. Next slide, please. In terms of effectiveness risks, again, Professor Velasquez mentioned that it might be sector by sector. I just wanted to kind of use one sector as an example. Healthcare, right? Obviously, something that's critical to each individual. We can have tools to assess whether the AI is working or not. We can also have a human in the loop to cross-check, to use the AI, but there might be over-reliance on the AI, and the more AI moves beyond what a human can decipher and the less it's able to explain what it's doing, the more risk we have that the AI will go down a wrong path and it will be difficult to figure out what's been going on. There's also privacy and security concerns, particularly in the healthcare space, given the sensitivity of personal data. And also the pace of replacement within the workforce. If AI turns out to have greater difficulties and some workers have been let go, that could lead to problems. Resource dependency, again, the next slide would be great. There's the technological resources of various chips and other hardware that are necessary. There's the software, there's the data that's necessary, and energy. There's capital, right? We've seen some indications of that recently. You wonder how much money SoftBank ultimately will have. And then in terms of labor, right? We need folks who are skilled and innovative enough to work on these materials. Those folks need to be educated, and a lot of times companies have pulled employees from outside the country, and that's an important risk that if we don't have the workers to implement on the strategies that the companies have, then they're not going to happen. All right, next slide, please. Thank you. Legal regulation, right? We've seen in the EU, not only with their AI directive, but also with Platform Workers Directive, that there is regulation in this area. And states are starting to take up the mantle. States and cities are starting to think about how to manage AI along with their data privacy regulation. Concerns about discrimination against workers, customers, users, concerns about job loss, right? When we had a huge displacement in manufacturing, we had the WARN Act. There might be something along those lines if large sets of workers are displaced because of AI. And then reliance on third parties for compliance, right? The less connected an individual company is with AI, the more they will be relying on third parties to make sure that they're complying, and that could lead to their own individual legal liability as well. Next slide, please. The impact on the workforce, right? Just 5 years ago, we had the human capital management rule development within Regulation SK. This is expected to have a huge impact on human capital and on the labor force, right? An IMF study thought 40% of global jobs, 60% in advanced economies. There will be productivity gains, but that will also lead to reduced numbers of workers' hours needed, according to studies by Goldman Sachs and Vanguard. Just last month, a Bureau of Labor Statistics study found that there will be gains or losses within, not only within industries, but within occupations within those industries. So for example, just looking at the insurance industry, claims adjusters might suffer a very significant drop in employment because of AI tools, but other aspects of the insurance marketplace might not experience similar drops. Next slide, please.
Professor Bodie, 5
Yes.
minutes.
Oh, thank you. There is a fair amount of existing SEC disclosure that companies are responding to in terms of providing information about AI within the description of the business, within risk factors, within the relatively recent cybersecurity rule. Next slide, please. Happy to talk more about those. In terms of disclosure, interesting, 2 recent studies, one by ISS, the other by Weil Gotshal, came up with different perspectives, right? ISS said only 15% of the S&P 500 provide some disclosure about board oversight of AI, whereas the Weil Gotshal study found over 40% of companies providing some disclosure about AI. Now, that might have been, one is looking at AI more generally, the other is looking at board oversight of AI, but there does seem to be a lot of disparity in terms of even outside observers looking at the disclosures and saying, what is being disclosed, right? And I think this goes to the heart of how do we define AI. If we can come up with a definition, we would be able to have a better sense, and investors would have a better sense of what is going on at these individual companies and be better informed about their investment upsides and risks. Next slide, please. In terms of what the SEC itself has done, a study by Orrick Harrington, folks at Orrick Harrington, looked at when did the SEC provide comments to disclosure, asked for more disclosure, asked for changes to disclosure. Materiality was obviously a big one, and that's both that companies are not disclosing enough about AI and that companies are over-claiming, right? The AI washing concern came up. Specificity and balance, right? Are the disclosures too ambiguous? Are they not telling us enough about what's going on with the company's use of AI? Also, how does the company itself define AI, and what sort of metrics does it use, right? Next slide, please. Also, there are a number of shareholder proposals related to AI. FTI Consulting went through a recent set of 14A proposals and found a number of requests for transparency on the part of shareholders making those proposals, but also the potential for AI oversight, such as creating a new board committee or including AI materials in the Audit and Compliance Committee. Next slide, please. All right. So in terms of thinking about a disclosure regime, this is just kind of my overview of what sort of building blocks we'd want to look at. Given the interest and attention in AI, would it make sense for the SEC to act? My answer would be yes. As Commissioner Crenshaw said, there are a lot of questions about what is AI, and perhaps work for the Commission to do in defining that. But I think it could provide a true service to investors if a working definition that was both flexible enough to accommodate the variety of industries and opportunities and applications for AI, while also providing guidance and a place for investors to look to find out what each company is doing in this area. In terms of a definition, there could be a uniform definition, kind of along the lines of item 106 with cybersecurity incidents and threats. Human capital was a more principle-based approach that left it to each company to self-define. There's been some criticism of that it's not specific enough. At the same time, one could argue that it might be a good start just to kind of see how companies approach this if they were asked to specifically kind of define their AI resources and investments and the risks, particularly for their companies. Defining the use in business, impact assessments, what is the impact particularly on productivity, but also on human capital? What are the risks as the company thinking about the variety of risks that could arise for them and informing investors about that? And what efforts can they take to mitigate the risk, particularly in this area? And AI governance has been a hot topic lately, and that's something that a lot of companies are thinking about. Next slide, please. So
1 minute.
Thank you. Finally, good timing. I have a set of questions for the committee to consider. What would the uniform categories be? For how long would they be relevant? Those are things I think the committee would really want to kind of think about in approaching this. What would investors want to know about managing the risks, right? I do think disclosure could definitely help in this area. And at the very least, it would make companies think through the various risks and articulate for investors how they were approaching those risks. And then finally, to what extent should there be discussion of impact on workforce and other societal risks within investor-oriented disclosures? That obviously is something that is a broader question for the SEC. And I think it's important to recognize that each company sits within a context, not only within an industry, but also within the nation as a whole. And it's important, I think, to consider how AI is going to impact that company, and for the company to think more broadly about what those impacts will mean for their investors going down the road. So thank you very much.
Thank you, Professor Bodie. First and foremost, I forgot earlier to acknowledge the work that my RA, Philip Lynn, gave me and worked on this project. So I wanted to make sure I got that out there because, he talked about getting help from your RAs. But secondly, I really appreciated how you raised some of the questions at the end. And I just want to highlight for the panelists where I'm going to come back to you is I'm going to ask you, if there's 3 or 4 categories that the committee should be thinking about as far as regulation or disclosure goes, to have a list of that. And I'm going to come back to that at the end after everyone has spoken. So with that, I would like to turn it over to Deep Ratna.
Thank you, Professor Alvin, and thanks to this forum for having us in here. It's an important topic. Pretty excited to be able to get my views on that. As we talk about it, I think that what I'll do is, and we were discussing in our prep sessions, is that I will discuss a little bit more about how we as a firm, Franklin Templeton as a firm, has been using AI or working towards the AI initiatives, and that may give you a little bit more of a tangible framing that this is what a firm is doing, how are they thinking about it, and then from there, we will try to extend those arguments to think about what could be of interest for investors. And then, of course, there's an eventual thing that should that be mandated and what should be the potential recommendations. But we'll spend a little bit more time towards that framing, keeping how a particular firm uses. And and my co-panelist, Professor Bodie made a very interesting observation about the fact that in the McKinsey report, there was a statement about the fact that 47% of C-suite feel that they are moving very slowly on AI. Now, while we are talking about AI and the uses and everything that's going around, the fact is when you look on the left and the right and you talk about the different firms when you're sitting in different forums, you see that something is missing. Everybody's talking about it. It's showing up in many different places. It's not exactly manifesting as the way you feel it would in the organizations. And why is that? And that's where I will take a little bit of a step back and say that AI we talked about AI. Let's first think about where is AI being used well. Not necessarily in organizations. One small example, and this is all hearsay, so this may not be right, is by school children. They are the biggest users of generative AI since it has happened, right? And why would that be? It's creative, it's helping a lot in their search, it is helping a lot in what they can do. It's being done by one individual, and which goes then to the teachers or whatever research they do, but it's between two very distinct entities, right? So very controlled environment, complete focus on what they can do, they have been leveraging AI. And I'm sure there are many other examples, including a lot of firms which have been using it for fake scams and others. The firms which are not using is a big corporations, the firms that are not using are small corporations, the ones that are working, they still struggle. We went through the same struggle. When we started off with AI as a function, we started to say we want to educate, we want to bring AI in a controlled environment to all our teams, and we started doing it, what I would call as a more diffused form of AI. So people have access to them, people can learn, they can create meeting summaries, notes, things of that nature, things that bring up their day-to-day productivity. But then what we also quickly figured out is that this is not what will move the dial for the firm. This will help us get prepped, this will start making an impact and start helping people to understand what AI is all about, but this will not move the dial for the firm. So what we did last year was we moved away from what we call as a use case mentality, that let's take these 100 use cases and start deploying AI everywhere, to start saying, here are 4 core areas that we really want to deploy AI in. It's our operations, it's our marketing and RFPs where we can really increase the engagement, it's with our distribution on how can we really personalize the support that we provide to our clients, and of course in our investment management, which is core to our business, and say how do we start shaping and changing the investment process, right? When we took those 4 core areas, and within them also, we are not going and trying to do it with everybody. We are taking a small set of teams or small business lines in each of these cases and say, let's map this process out and say, where can AI fit in? And that was a big turn, because you start realizing very quickly is that AI can be a catalyst, but AI standalone cannot really change the organization. What happens is, it's a very complex mix of having AI capabilities, but they in turn need to talk to rest of the technology applications that you have in the organization. They need to be able to talk to the data, which is both external public data as well as internal private data at different levels of controls with different authorities by different users on how they can use it. It then needs to be meshed with an oversight of an individual on how they are going to use it. And it needs to be broken by different departments which actually come together to really create any value proposition. Once you do it, you realize that AI is not a standalone capability. We started calling it more of what you'd call as a digital transformation, because you really need to bring this all together and then start saying how will AI start mapping all, having an impact on these systems. So there are control teams which are trying to say that can we really disrupt and change the end-to-end working of our workflow? But those small control teams are doing it with a lot of oversight, and they are trying to see that every step of this process, what works with AI, what works with a different technology, what works with a human, where does a human need to come in, and now we are going through that process. It's a slow, deliberate, and a very long-term process, and that is why you see those questions come up, because it cannot happen overnight. Now, why I'm expanding this too much a lot is that when you think about from an investor perspective, what would matter? What would matter for them is that, okay, with all that you're trying to do, what is the impact that it is going to have? And then we can be, with these 4 clear objectives, I can be very clear in what that impact would be. On our operations, it would increase the scale of our operations. On our marketing, again, it would increase our scale, which may be less about cost reduction, it may be more perhaps about cost avoidance, because we know that we really want to respond to our clients in a much more timely fashion. We are not doing it enough. It allows us to give that capacity on how we do it. With the distribution, it will go a lot towards how can we really personalize, how can we prevent having a pure product mindset as we are trying to sell to our clients, and how can we get more consultative by really understanding the client needs and fitting them into every conversation that is done by any touch point. And then, of course, the big one in the investment, where how are we taking the research processes, how are we going to expand the capacity of our investment teams, how are we going to improve portfolio oversight, and how are we going to do the risk management. So now, from an investor perspective, what's of interest? Actually, it's less about AI. The interest is about how much productivity gains are you targeting in these areas. The questions would be way more about how much demonstrated difference do you see in your sales and marketing team's capabilities to interact with the clients? How are you seeing a shift in the CSAT scores or the effectiveness scores or whatever those end scores would be? Understanding all of them, and yes, on the investment side, how are you seeing the scale go up? How are you seeing the depth of the markets that you're covering go up? These things can be made very tangible in very business terms. And I think that's where, coming from that perspective about what AI can do, if you have to then, what could be a potential interest, then the next question for that would be, okay, how are you going to make this change happen? One, are you investing enough? And that's an important question, because if we are not investing enough, then as a firm, any firm which is not investing enough in AI, it has a very big risk of becoming, outcompeted, redundant, or having a value proposition go down. So yes, you need to be able to first demonstrate the client objectives or the firm objectives. You need to be then, as a firm, be able to demonstrate, are you making the right investments towards those objectives? And three, stress a lot about what are the change management processes, what are the control mechanisms, and be able to really distinguish between what are the critical few things that you are having an impact on and where the risks are the highest, versus a lot of small things in which AI will diffuse itself across the entire organization, and you really will not have to worry so much about the monitoring controls because they are simply productivity tools. So I think those three levers, the business objectives, how are we investing, and what is the underlying technology stack that we are building towards those investments, and eventually what is the change management, the processes management, and the compliance, those in my mind are the three levels by which you would see something that investors could impact.
Can I jump in really quick? I just want to clarify one thing. You mentioned investment and investment. Do you mean investment solely in the AI technology or as it impacts the business writ large? Can you clarify?
I think that's a great point, Professor Alvin. I would say the latter, because those investments again would not be, if someone says that we are investing X million in the AI as an example, and they're not talking about any investments they're making in towards the work shift or about how the change of the people is happening, the knowledge bases are going up and so on, that in itself is a significant risk for that firm. So I completely agree. Those investments need to be talked about in a more holistic about how are you really shifting the transformation. Okay. So those in my mind. Now, the final part where we really need to spend some time, perhaps we will end up talking about as we do in the panel, is that, okay, based on this, how do we change investment disclosures, right? I honestly cannot say, have a perfect point of view on that. I'm not an expert on that. I can tell you what the risks and material risks are. It's very important to know there can be a lot of AI with very little risk, and there can be some pockets of AI where it can have huge impact. So are the critical few elements being called out? I would want to focus all the disclosure and things on those which are the critical few elements. And two, the another part that you would want to call out from a risk perspective is what is the intellectual property AI versus what is a technology that you are buying off the shelf from some other firm. Because if you are taking, say, a large language model and simply deploying into your system, yes, you are taking lots of risks. The risks of a large language model are already out there and known in the market. What you need to be able to articulate is, if you are incorporating them, then how is it changing the process, and what are the controls to say that all the challenges that a large language model can bring in, how are you really mitigating those, right? So those kind of elements which are specific to areas which are impacting the clients, which are impacting your core objectives, and where the level of decision making by humans is minimal and much more being driven by some of these systems, those are the elements that you really need to stress out. And that may perhaps be some management between not creating a burdensome disclosure or creating a lot of noise, but making sure that those critical few elements are being really taken care of. And in that space, it's also important to point out that is the oversight mechanism of the firm driven by a few technologies who are sitting in the side making those algorithms, or there is the firm have oversight mechanisms which are more cross-functional in nature. As long as some of those are covered, I don't think I would be pushing for too much of what you would call as too much disclosure. The disclosure needs to be along the business lines, but the critical few that really matter is where we should focus on. So that's kind of the summary of what I was thinking, what I really wanted to get my argument around.
All right, thank you very much. I was going to say I'm going to hold questions for the IC after we get through the presentations. Excuse me. So up next should be Hamish McAllister, who is going to be joining us online today and has a PowerPoint as well.
Thank you so much, and thank you for the invitation today. I apologize I can't be there in person. I'm currently sitting over the other side of the world in Singapore at the moment, and couldn't fly over for this. But it's a great privilege to be able to have a conversation with you about this today. Now, I don't know about on your screen, but on my screen, the slide deck is appearing sideways. So what I might do, hopefully this works, I'm going to share my own screen. I think that's probably a better way to do it. So I hope the technology allows me to do that. So let me just share my screen. 1 second. Okay. And view slideshow. So I think now, hopefully, my screen will be appearing on your setup. Fantastic. I see a couple of nods there. Look, what I'd like to do today, I realize, the focus is clearly around the notion of, obviously, firstly, a broader discussion of AI, but then in particular, focusing on the notion of disclosures and what should be required in terms of companies disclosing AI. What I'd like to do is to slightly flip the script a little bit and pose the question of why not the Commission use AI itself to assess the disclosures from companies. And what I want to do is to give you a very practical perspective on this. Again, it's very easy to start talking about AI in quite abstract terms, but I really like to bring it back to something very concrete so you can get a very, very clear sense of what might be doable in this space. And I particularly want to focus in on one aspect of this, again, so it's very clear, which is disclosure of financials. I mean, obviously a very, very fundamental concept. And to what extent, for example, the SEC themselves could be using AI to assess disclosures. So to put this in context, there's independent academic research that suggests, from the US, that suggests 40% of companies, publicly listed companies in the US, manipulate their accounts each year. Now, manipulation obviously follows a vast spectrum from something completely mild, completely legal, all the way to outright fraud. Having said that, that same research suggested that 1 in 10 companies commit securities fraud each year, which is obviously a pretty staggering number. Now, if we put that in dollar terms, that's in excess of $1.5 trillion a year. Now, that's a global number, but that's equity holders alone. So if you add in debt holders, you're going to be at least doubling that. If you add in losses to customers, suppliers, employees, etc., we're talking major impact on the public at large, essentially, of this effect. Now, the challenge is that I think a lot of people consider that the auditors are covering this off, but in fact, again, separate research finds that external auditors, when there is wrongdoing in the accounts, only find it 3% of the time, which is obviously an astonishingly low number. And of course, everyone relies on the financial information. So this is obviously a critical type of disclosure that companies make that clearly needs to be assessed. So from an ideal standpoint, obviously, what you would want is some sort of AI-powered system for the early detection of accounting manipulation. Now, this is a notion which is a perfect problem for AI. If you think about a good combination of problems for AI, you have something that's very complicated. It's multidimensional, which is obviously what accounting manipulation is. You have a problem where there is a lot of data, which is obviously something that we have. We have vast quantities of accounting data. But also you have a problem which is dynamic, because traditional static models can't cope with a dynamic world. And never underestimate human ingenuity when it comes to trying to circumvent rules and regulations. So this is obviously a dynamic problem. It's constantly changing, and companies are always inventing new ways to try and hide what they're doing. Now, I'm obviously not here to give a product pitch, but what I need to do is just give you a tiny little bit of context first before I then go on to show you some numbers to sort of put this in perspective. So what you would want ideally is a system that essentially provides you with ratings for a company, A+ through F, on accounting manipulation or fraud at the extreme end, risk scores that provide some assessment of the extent of manipulation and subsequent corporate collapse. But what I want to emphasize to you now, for example, is there is already AI technology out there that allows you to generate full forensic reports. So, for example, you can generate a full forensic accounting report on a company that could be anywhere from 10 to 45, 50 pages long, that details all of the problematic aspects in that company, recommends what to do next, provides data to back it up, and those particular reports are generated in 2 to 3 seconds. So that's probably, at least 2 to 3 weeks, maybe a month's worth of work by a team that's converted to 2 to 3 seconds on any listed company globally. So you can imagine the vast productivity gains that can be achieved from that. So to put this in perspective, I just needed to give you that little bit of context to put this in perspective. So for example, this current system that's out there, if you look at ratings for companies on the basis of accounting manipulation, and you look at the C- to F rating bucket, which is where the system recommends some investigation is required, that system suggests that 37% of US listed companies over $1 billion market cap fall into that category, which is 744 companies. 93 of those are rated F. So to put this in context, that means that 93 companies over $1 billion market cap have the same level of risk in this system as an equivalent would be an Enron or a Wirecard, for example. So this is, I know that's a somewhat provocative thing to say, but this is, this is essentially the reality of the situation we find ourselves in now, that there's a significant number of companies where there is this extreme risk that's being shown. Now, the obvious question is, well, how do you really know that? I mean, can you actually build an AI system that can identify these sorts of problems? Now, traditional methods, we estimate, can predict roughly 50% of accounting manipulation by companies. I'd rather identify 50% of high-risk companies, i.e. companies with very poor accounting quality, where there are deep problems in the accounts, suggesting that there is something, there may be some form of malfeasance. But that's 50% even after the last published results. So it's basically a coin toss. Whereas this AI system is predicting 90% plus of high-risk companies, even 3 years prior to their last published set of results. So this, I think, is a very important point to make to the Commission today, that while we hear about AI and we hear about benefits from AI and it can make things better, enhance productivity, etc., that in many instances we're not talking about some small incremental improvement. In fact, there are systems out there, this one and of course many others out there, systems that are actually able to provide essentially a quantum shift in the level of accuracy in terms of identifying things that are of great pain points to the wider public, and therefore of great consequence to the Commission. And on top of that, what I've described so far is essentially what I would call a predictive AI, or essentially a forecast AI or predictive AI. On top of that, you can have a generative AI system interpreting it. So there are systems out there. I've got one running here, just showing again interpretation of an AI forensic accounting system, but basically systems that essentially allow you now think of it like a ChatGPT, but trained to be a specialized forensic accountant. So you can just talk to it. You can ask any questions you like related to forensic accounting on any listed company. You can create charts and tables, etc. But also, very importantly, you can tailor the use case. That's one of the great powers of generative AI. So you could tell it you're a regulator and you want to investigate a particular company and what should you be focusing on and what questions you should be asking. But you could say, for example, I'm a forensic auditor, or I'm an investment analyst, or I'm a bank relationship manager, and it's going to give you a different response because the system will automatically understand that there are different levels of expertise. So this is me just essentially illustrating the power of what is already out there and what's already doable in the space. And to put this in context, this particular system I've been referring to has already been used by asset managers, auditors, banks, and of most relevance to today, regulators and exchanges globally. So there are some very big name regulators and exchanges around the world who are already using the system. What are they using it for? What companies they need to investigate. So it's fraud detection, systemic risk for the wider market, and of course, monitoring the wider market. And on that note, I will pause and stop sharing my screen.
All right, thank you very much. Really appreciate that. I was going to say, next person we have is Rekha Vaitla. I know I'm getting your last name wrong. Help me out here. Okay.
Got it right.
Thank you. Why don't you go ahead?
Sure, thank you. So I appreciate the opportunity to share perspectives with such a distinguished group here today about what is one of the most critical and rapidly evolving topics in the financial markets. So as Alvin mentioned, I'm an investment officer with the California State Teachers Retirement System, or CalSTRS. CalSTRS is the largest educator-only pension fund in the world with $350 billion in assets, thus providing retirement, disability, and survivor benefits to California's more than 1 million public educators and their beneficiaries. We are a long-only passive investor, and one component of fulfilling our responsibility to our beneficiaries and providing risk mitigation is through our stewardship work, where we actively engage with our portfolio companies to address systems-level risks to our portfolio. And as has been noted, AI has the potential to reshape industries, business models, workforce dynamics, and so the need for clear disclosure has really never been greater. As part of our stewardship program over the past year and a half, we've actively engaged with portfolio companies across industries to understand the implications, opportunities, and risks of generative and, to a certain extent, predictive AI. And given the potential opportunities and risks, we feel the need to carefully evaluate what this means for our portfolio. We obviously cannot speak with every company in our portfolio, given that we are highly diversified. So our approach has been to segment companies that we speak with into 3 buckets that we felt face different risks and opportunities around AI. So one, technology companies, developers of these tools, given concern around bias, hallucinations, safety. And the second group was around companies supplying the infrastructure and inputs for this AI boom, so data centers, chip makers, mining companies, given that this is an important part of the value chain and comes with significant growth, opportunity, and volatility. Then the third was the end users. Those who will either be using a product off the shelf or developing tools internally and need to think carefully about either vendor due diligence or internal controls. And there's certainly some overlap between these groups, but it helps us understand what utilization and implementation looks like and where effective risk management structures and internal controls are required. So at the end of the day, since the board is also our representative in ensuring that investor needs are protected, understanding board level education expertise and what's relevant has also been very important to us. So coming out of speaking with some of our portfolio companies, some of our assumptions were validated. We knew that companies were well ahead on the implementation of predictive AI front. I'm sure everyone here has interacted with numerous chatbots and algorithms already power a lot of our world, and machine learning is woven into day-to-day processes that we interact with. But there's a slightly different conversation to be had around generative AI. It's something a little bit newer. Folks are still thinking about the use cases, and companies are hoping to acquire new efficiencies, but many have not fully figured out how yet. Just using healthcare as an example, given that there are different use cases across different industries, and so we've engaged with various different industries across these buckets that I mentioned. But there are some companies that use predictive AI in modeling proteins for drug development and Gen AI to relieve administrative burden or have some legal implications, but while others that we spoke to are staying far away, they don't want to be a first mover. They want to be really thoughtful and slow with how they implement and think through what tools they're going to be using. And that's kind of the landscape that we're seeing across industries, is that there's a mix of folks and the stages in their implementation are varied. And right now, as we look at AI disclosures in corporate filings, particularly in 10Ks, we're seeing that there's increasing disclosure, but it's inconsistent. Most disclosures that we saw were amongst companies in communication services, financials, unsurprisingly IT companies, and when disclosed, we were seeing them most commonly disclosed as a risk factor. And so while the information that we're able to glean has been increasing, there are still certain trends across limitations and gaps in disclosures. So a distinct lack of standardization is something that we've noticed, with no specific requirements for AI disclosures. Companies provide varying levels of detail, making it difficult for investors to compare strategies across firms. And there's Many disclosures also lack meaningful details and use broad language, for example, leveraging AI to enhance efficiency, without specifying use cases, risks, or measurable impacts. And so there are generic or vague statements out there. There's also an omission of AI-related financial metrics. Most companies do not break down how much they spend on AI development or how AI contributes to revenue, leaving investors to speculate on financial significance. And we also see the potential for AI washing. Without clear standards, companies may exaggerate their AI capabilities, misleading investors about their technological advancements. When you have such a broad range of companies, it can be hard to know where in the process they are. But overall, the landscape for disclosure is varied, and we're looking at the various disclosure frameworks that have been put out by industry groups, international requirements, other entities, to see what best practice looks like and what will be most useful to investors like us. We want to see companies use AI responsibly, effectively, and in a way that creates long-term sustainable value, particularly for our beneficiaries. And so meaningful disclosures are something that we think are critical to ensuring that capital is allocated to businesses that leverage technology for growth.
All right. And imagine you're done then?
Yes, I'm done.
All right, thank you. And I guess we'll go to our final panelist, Paul Washington.
Great, thank you very much. Thanks for having me here, delighted to participate. And a general thanks to the SEC for the work of the staff here and the commissioners. We at the Society deeply appreciate the professionalism, the hard work, and really deeply appreciative of the excellent work by the SEC, which needs to continue to have the resources to do its work. Amen, right, on that one. Also just want to give a bit of a caveat here. So while I'm CEO of the Society for Corporate Governance, we have a sort of thorough process where we go through to develop our own policy positions. We have not done so in the area of AI. So I'm not going to purport to speak on behalf of our 3,800 members, but I will be speaking from the perspective of someone who worked at a corporation for 20 years, engaged with investors for a good 15 of those years. We had so many activist campaigns against us, I got very used to engaging with investors. I used to be, one major investor used to say that I did an annual apology tour in any event, and also someone who worked as head of the ESG Center, the conference board, where I authored or co-authored some pieces on AI. So with that as sort of a bit of a caveat to what I'm going to say, just a few observations, and hopefully constructively building on what you've heard. I think as we're thinking about the SEC's role here and disclosure requirements, I think it's important to recognize that while AI in general has been around for decades, we are still at a nascent stage when it comes, in some ways, to generative AI and even to some extent predictive AI. As was noted, we don't actually have consistent definitions even on these terms. I would encourage you to check out some of the definitions we came up with at the Conference Board as a leading think tank serving the business community. I think we actually came up with some decent definitions you might want to consider working off. It's also nascent in terms of companies' understanding of the impact of AI on their business. And it is also particularly nascent. I think, Deep, you made a terrific point in understanding the actual, not just potential impact, but the real impact. Like, what is it in fact doing in terms of increasing efficiency and of marketing and so forth? So we're early on. The second point, general point I think is important to keep in mind is that this is obviously fast-moving and unpredictable technology, right? One of the programs I helped run last year, a Digital Trust Summit, and there's a published piece which I've shared with Alvin on this, talks about the course of generative AI over 4 years of going from the level of being an intern, who works for you, to being a full professor, to being a departmental chair, to being a world expert in the span of 4 years, right? By the way, that's not to denigrate the RAs or interns. They may, in fact, be world experts already. Just want to let you know. So maybe it goes in reverse. Anyway, but it is fast-moving, and so that's also something to keep in mind. I think the third point I'd make is that we have seen companies move rapidly to increase their disclosure in this area. I think the ORIC study was referenced earlier. And if you look at the inclusion of AI and a risk factor at the S&P 500, I think in 2022, only 12% of companies included it in there. 23, I think it was 16%, and 24, it was 60%. So clearly moving up in the risk factor realm, and even in MD&A, we've seen an increase over those 3 years from 28% to 40%. So it's not quite where it is with risk factors in the MD&A, but you're seeing an increase in disclosure. The fourth point, if that's where I am in the numbers, is that we are seeing a variety, a variation in disclosure, but I would submit that that is entirely understandable. There are companies, so for example, you'll see that communications companies, companies in the communications sector, 90% of them disclosed AI as a risk factor, but only 40% did so in the energy sector, right? So I get that, right? There are some companies, and we're talking about where they disclose in a risk factor. It's not all that surprising that IT companies are the most likely to include the sort of mega AI risk factor in their filings, whereas other companies will incorporate AI in one or more other risk factors. So I actually think this is really just quite natural, given the difference of the impact of AI and the understanding of AI based on industry sector as well as on individual companies. Having said that, obviously, the disclosure can benefit from greater clarity of what people mean by AI and the subsets of it. But I guess I would submit that I think what will be of most use to investors is actually clear and coherent disclosure by each company of what is material to them, rather than striving for what I would perhaps be artificial consistency in disclosure across companies, right? Because I think, this is based on my own experience. I'll give you an example from when I was at Time Warner. When we talked to our investors, and we were early on this, about our sustainability strategy as a media company, why, and we define sustainability broadly. It was financial, operational, environmental, social sustainability. It was a broad definition of sustainability. And the things we focused on were things that were important to the company, to its stakeholders, and society at large. So that was how we filtered through what were our key sustainability elements. We talked about things like rule of law, protection of intellectual property, diverse content for diverse audiences, right? Those were our issues. Those were not the issues that necessarily every other company cared about or that investors were looking for. And I will tell you, investors reacted very well to a coherent story by our company of what mattered to us, rather than looking for us to disclose things that actually weren't all that relevant for a media company that had apart from our executives flying on corporate aircraft, a small GHG footprint anyway. So yeah, I would suggest that. And then I guess I'd also say that, there are, in these areas, it's important to keep in mind that AI is just one technological development that we'll all be grappling with, right? Whether it's quantum computing or so forth. AI goes along with demographic changes. It goes along with, so technology goes with demographic changes, goes with sustainability changes. And in every case, the question is, how is the company taking advantage of these for its own benefit? And I think, and for the benefit of its investors. So I think we're at a stage where encouraging and enabling companies to provide clear, reliable, coherent, authentic, and effective disclosure is really the goal. And Alvin, I think I don't want to go on any longer, but I'm happy to talk about what I think the key here is to help provide companies with different frameworks for them to internally think about the impact of AI and what they should be talking about when it comes, what they should be considering in terms of AI. And then that will naturally flow through in their communication with investors about AI. And I think you can get more robust communications about AI if companies have a framework for thinking about all the things they ought to be considering internally. Some of that will show up in SEC disclosures, but some of it won't. I think that's also an important point. There are limits to the SEC disclosure framework, right? There's stuff that fits into your MDA. There's stuff that fits into your risk factors. But there's a lot of a company story that will naturally fall outside the SEC disclosures. And so I think equipping companies with the sort of items that they should be considering when it comes to the impact of AI and things that they should be addressing will then result in a robust subset of that that's disclosed generally, and then an appropriate subset that's disclosed in SEC filings.
So I have the rare pleasure of saying that we're actually running ahead of schedule on a panel, which is not always what you get when you're, bringing together a lot of good people. So I have a couple of questions just to kind of get us started, and then what I'll do from there is pivot and open up more generally, because I'm sure we all have a lot of questions on a very timely topic. So let me start with Professor Bodie. You discussed having a framework, right, to start thinking about AI disclosures, and I was wondering if you had, to start us off, 3 to 4 categories, or maybe more, that we should be thinking about in light of this presentation of categories that would be useful for a starting place in terms of how we shape a recommendation.
Right. So I think just going off one of my slides, obviously we've talked a lot about definitions, that being a important category to kind of develop, right? What does it mean? Do you want to approach it as kind of an umbrella term, or do you want to narrowly define specific types of AI? Do you want to focus on generative AI, or do you want to broaden it to more machine learning, algorithmic management? And do you want to try to come up with an overall definition? Do you want to come up with a sector-by-sector definition? Do you want to let companies kind of develop that on their own, and then, with kind of a broad framework, but let companies kind of develop it further, and then see how that trends over time, and maybe certain categories will develop naturally from the disclosures made by the companies. Second would be business use, right? How exactly is AI being used? What are the impacts on existing employees? What are the impacts on existing business? What are the efficiencies? And how might AI be developed further by the company? What is the company's strategic plan for using AI in the short and the medium term? Risks, obviously we talked a lot about risks, so there are a lot of different risks. I think that would be obviously an important centerpiece for the disclosure. And then finally, risk management. What is the company doing to try and manage those risks at the board level, at the C-suite level, at the employee level, right? Great point made about it's one thing to buy, particularly if you're not one of the companies developing AI itself, it's one thing for a company to invest in AI contracts or AI tools, but how are you working with your existing labor force, with your existing structures, your existing business frameworks, to kind of build that in so that it's not an expensive toy, so to speak, that's not really being effectively implemented within your company. So I think those would be kind of the 4 things that I would look for.
Okay, let me follow up with one question for you then. Because you have an expertise in kind of labor and employment as well as corporate law, and I want to take advantage of that here for a second. So you have in one of your writings a Moneyball movie analogy, right, where you talk about how worker input or employee input can enhance data analytics. So from that perspective and on that point, which disclosures do you think would best inform investors about the extent of employee involvement either in AI design or use? and how should firms balance that against the potential risk and benefits that the potential risk that they'll be facing as well?
Well, part of it is employee data being used, right? We've seen a lot of development over the last decade plus of what was called people analytics, or what it still is called people analytics to some extent. How can we draw data from our employees to help them become more productive, to make the system work better? But there has been pushback, right, on a lot of privacy issues, and also to some extent how to manage the gains from that productivity over the long term. Do employees get to share in that or not, and in what ways? So I think in terms of looking at it from an investor perspective, and kind of matching this up with the human capital management framework, you would want to think about, one, what are the risks to my business strategy? How dependent will I be on AI? How am I integrating this into the workforce? Is it helping my workforce, right? Is that kind of that superpower idea that we were talking about earlier? But, or is it a replacement, right? Is this something that will ease a set of employees out of the company and kind of take over for them? And if so, what are kind of some of the backup frameworks for managing that transition? How are you going to manage the risks if your company has been successful with its workforce and has developed a strong workforce? What are the risks of switching that? What sort of competition might you face? I think those are the things to think about. And then also in terms of exterior regulation, right? I think a lot of workers are anxious about AI, and to the extent that there is pushback at the federal or state or local level about the use of AI, either for me as an employee or me as a consumer, right? There might be greater regulation of the use of AI, and companies have to be thinking strategically about how that might impact what they want to do, and how they can kind of balance those concerns against the concerns that they have for productivity and efficiency in their own business.
Thank you. Deep, turn to you. You talked about kind of not only just your 4 core areas, but also like doing deep disclosures, right, into kind of mission critical AI functions. Can you tease that out a bit and kind of explain to us a little bit what are the kind of, if you had 3 to 4 categories, right, of AI operations that you would want to kind of have companies go further in rather than broadly in terms of their disclosures, what would they be?
I think one, to just carry that point forward, is that you would want to think about the capabilities that a firm, propositions that a firm manufactures and sells are different from the enabling capabilities and the day-to-day productivity and the dashboarding and so on and so forth, right? So there's a significant difference between one, the propositions themselves. If you're talking about AI within those propositions, it's completely different than when you're talking about AI elsewhere. And within them as well, there are places where you would have significant human oversight, and then there are places which would have less human oversight, right? So it's that less human oversight when you are engaging with an end client is the part where perhaps those criticalities really matter. Because if end of the day, the whole decision is being taken by a human, and AI is just an enabling capability to be able to get then the impact of that is different from a disclosure perspective. Now, from a strategy perspective, it may be important that a firm wants to keep all the human decision making in place, but it can create much bigger scale by allowing AI to harness that information faster. But that necessarily is not a systemic risk or something that a firm may eventually be facing, versus when it is changing. For example, a client, let's say, there's a client satisfaction firm which, client experience, customer service firm, which is bringing AI to solve all the problems, and those are the only human, there are no human agents involved. Yes, there's a big difference, right? Versus when AI is being used, that a human agent is actually responding to someone's queries, and you have got a lot of information that the human is able to pull fairly quickly. the dynamics change significantly. So understanding and focusing on those critical few, those matter. And then the rest, I think, is, as Paul already mentioned pretty well, is that when a firm is talking about it, is the firm coherent in its overarching strategy? And then AI becomes just one component of that strategy, because today it is cloud, tomorrow it could be quantum computing, and then there is AI thrown in between. Those become relatively less material. So that coherence within a firm's statement, I think, I think that was a great point, is much more important than necessarily as a standout disclosure.
And then one other question is, you're in a very unique position for our panel in that you're thinking about artificial intelligence both on internal operations as a manager, but then also in terms of handling, engaging with portfolio companies, right? Or is there any tensions that we should be aware of that in making a recommendation that put either companies situated like yours in a kind of box in which we're giving inconsistent guidance, right, to the SEC and encouraging the SEC to make rulemaking that would put it in a bind that says, look, like how we behave internally or disclose our internal affairs is very different than external, and this is not going to work.
No, I think that's a fair point, Alvin. And I think, to your point, firms do need a lot more internal disclosures. What they come out with external disclosures is different, but they don't have the right checks and mechanisms to talk about their own internal disclosures. What you really don't want a firm is to be a path where a few technologists are deciding everything for the firm, because really nobody would know about it. So within a firm, for all the core areas that we talked about and so on, it's very important that those oversight mechanisms are cross-functional, the way the processes are moving are cross-functional. Not just the risk part of it, but you also have a big risk that those investments may not bear the ROI and the value to the shareholders that you're actually doing if you are not having it in the right form. So that's the internal element of it. When it comes to the external part, honestly, that's the reason I'm trying to segregate between, and again, I think Paul talked about it and other panelists also mentioned a little bit of that, is that on the external side, it's very important to understand how these things matter. I am not very sure that everything needs to be standardized and disclosed in a particular way. So understanding those sensitivities, creating guidance around those sensitivities, creating guidance around those coherent statements and connections with the business strategy of a firm, in my mind, are significantly more important than what we eventually come out as, here are the tangible recommendations that we need to do. So hopefully that's one way to resolve my conflict and get out of this. So,
no, thank you. But it just kind of gets to a reality, right? That there's certain company. I want to make sure that whatever recommendation we put forward is operationalizable, right? And if you put companies like not just yours but others in this kind of weird conflict situation, then it's not very helpful. Thank you very much. Let me move on to Hamish. So I'm really intrigued with this idea about how AI can be used to kind of foresee calamity as in a company. And I, especially as somebody who studies bankruptcy law, you catch my attention as soon as you talk about companies and calamity. And there's research that suggests outside of this, for example, I was thinking about work by Christine Lalova, who argues that in terms of predicting insolvency, employee data can demonstrate about 3 years out when a company is going to face a potential insolvency proceeding, and that is more accurate than certain financial metrics that are predicted by what's called the Z curve, the Altman Z curve, right? My question for you is, how effective can AI be in predicting like financial outcomes and calamity, and specifically, are there issues with false positives? Can it really predict the next high-profile collapse? And if so,
Sure.
how, and how can it work with the human element as well?
Absolutely. Look, you're absolutely right. I mean, there are myriad data sets that can be employed to evaluate these sorts of issues. And again, that's one of the powers of AI. It can digest vast sums of information. And what's really important is the AI is also not necessarily wedded to our own bias So, for example, if you're a forensic accountant and you're evaluating accounts, you're going to be doing that on the basis of your training and your experience and what you've encountered before, what you've read, et cetera, et cetera. Whereas there might be patterns there that you don't recognize at all, that in fact only an AI would pick up on, that at first glance may actually seem counterintuitive. So, for example, you can employ not just what's called supervised learning, which is where you actually feed the system or essentially give the system guidance basically on what you're looking for, but also unsupervised learning, where you don't give it guidance and you essentially just ask it, what can you find and what sort of patterns can you identify? So that's really powerful. But to take it to the next step in terms of building certainty into these systems, there is one challenge here, which is for anyone who wants to utilize such systems. How do you assess them? And that is easier said than done. That is a complication. Obviously, there is some expertise that's required to do that, and obviously track record of the company, et cetera, et cetera. But in terms of the technical problem, again, that can be solved. So, for example, the system our company has is actually built into it that as the risk of a company increases, the level of certainty of the company also increases, not the other way around. They're not inverse, they actually work together. And in fact, we built a system that it has explicitly built into it that it minimizes false positives. So by way of example, I mentioned before this, 93 companies over $1 billion market cap in the US today that are rated F on our system. We know historically, and again, I don't want to bore people with details and statistics, but proper out sample testing, et cetera. We know that historically, anything that's F rated, if we came back again in 3 to 5 years, 90% plus of those companies will no longer exist or be a shadow of their former selves. So what that means is the level of false positives is actually extremely low, which is very, very critical for anyone like a regulator or in fact an auditor or a bank or whoever it is utilizing such systems, whether it's the one that I described or any other system. It's all very well to have a black box that tells you XYZ company is problematic or you need to do something, but you need to have a system that can also not only minimize those false positives, but can also explain how it got the answer. And the nice thing is now I know there's this mentality of AI all being black boxes, but there are ways to actually flesh out much more detail with regard to how any AI system would, when I say any, not all of them, but how some AI systems can actually generate meaningful output and how they got to that and provide you with a significant color around that.
All right, I have a follow-up for you. So, and this is admittedly a kind of a meta question. So how can AI lower compliance cost for companies concerned about the reporting regarding AI risk on its operations and financial reporting? I know again, I know it's a little bit of a meta question, but I was wondering if you could help us through that one.
Yeah, look, I guess a couple of things I would say about this. I mean, obviously, the overarching concept, which has been touched on by a few of the panelists today, is productivity. So AI systems can generate, and again, I alluded to this before, explicitly mentioned before, the notion that some AI systems are not just some marginal incremental improvement. They can be this quantum shift. So, I made the reference to a financial report that might take a month for a team, but instead can be generated in 2 to 3 seconds. That means that the companies themselves have, and the people in those companies. So I'm not even talking about replacing people in that context. I'm talking about a situation where those people actually have more time to evaluate other aspects of the business, or whatever their role is, essentially, with the valuable time and resources they have. So I think productivity is the overarching issue. But what I would say, and this goes also back to some comments from some of the other panelists, is that while we are bombarded in the media with stories about AI, and some of those are fine and some of them are pure hype, the reality is, at least in my experience, the reality is the adoption levels within companies is really quite low. And I know we've heard some disparate statistics today on this. For what it's worth, my own experience is that the levels are quite low. And the reason is there's a lot of fear. There's a lot of fear and uncertainty. So, if you're a risk manager, a compliance manager in a company, you're going to look at this and your gut reaction is simply going to be to say no. So we have encountered some very large global companies that have right now blanket bans on all use of any AI technology whatsoever because they don't understand it, they don't know, and they don't know how to evaluate the systems properly. So the obvious question is, well, is this AI system taking my data? Is it tracking our activity? Is it learning from our inputs or whatever we're doing with it? Is it training on us, for example? And these are all questions that can be addressed and are perfectly valid issues to raise. But nonetheless, this I think is really quite significantly slowing down adoption rates.
So my colleague Paul has a question for you.
Yeah, thanks to the panel for great discussion and your insights and perspective. We've talked about trying to help companies come up with a framework to think about AI disclosures. And I guess I just wonder, looking at Matthew's materials and the ORIC analysis of CorpFin comments on AI disclosures, I mean, it seems to me that that's a basis for coming up with a framework. If you go through those comments and the areas that the staff was calling out in terms of are the disclosures material, do you have a reasonable basis, for the assertions that you're making about AI? If you go through that list, to me, it's sort of a framework of how a company should maybe approach AI disclosures. And I guess really my question is, and Paul talked about how fast-moving this area is, are we in a situation where we should be urging the SEC to, provide guidance about how companies should approach AI disclosures as opposed to trying to standardize, trying to put rules in place? Because this is such a fast-moving area. By the time you put some rules in place, they're obsolete. So, again, Matthew, when I looked at that analysis, I mean, it seemed to me that there was a way, that was at least a starting point where the SEC could put together guidance and a framework that companies could work through these issues. Any reaction to that?
So, by the way, I thought great presentation. I think the way I think about this is, see, I'm really hedging. I think the way I think about this, right, is as follows. Because first, when disclosure is sort of it's the tail here, right? So first you got to figure out what it is you're talking about. And then you have to figure out how you're approaching it internally as a management and then as a board. And I think when I think about the framework for what companies should be doing, you first think about what aspects of AI matter. Where is its potential impact for the company? To my mind, that's not a materiality analysis. That's actually a strategic analysis that goes deeper, right? Because materiality analysis tends to be fairly static, right? And it's really, let's look at where we are, where we want to go, how we're going to get there, how's it going to affect us. The next thing is, and this is probably at the heart of the framework to my mind, is, okay, how are we integrating it into our business, right? And the first thing is, and I've done some writing on this, is I think there are basically 3 or 4 realms where it has an impact on your business. The first is in the marketplace. And this mirrors some of what you've got, but it's somewhat differently organized. The first is, how does it affect us in a marketplace? So marketplace is, first of all, your business model. Is it going to actually fundamentally change your business model? Second element of the marketplace, is it going to affect the products and the services you sell, right? And is it going to affect the products and services you buy, your supply chain? And is it also on the ones you sell, is it going to affect your distribution chain? So I think you want to think about it in that area. The second area where it has an impact is it going to affect your operations, your workplace, right? So marketplace, workplace. That's your operations and that's your workforce. I think this is an area where people don't quite know what the impact is on the workforce, but obviously that's an area where I think you will see increased disclosure. The third sphere is, how is it going to affect you, or how are you going to address it in the public space. And so public space involves the regulatory world, right? And, you know, I think the European AI regulation could have a very significant impact and maybe even a chilling impact on innovation in this area. So how's it going to affect you in the regulatory world, in the government relations world, and in, frankly, your company's reputation, and so forth. So I think if you think about those areas, and then the one I would add at the end, which is a little bit of a meta area, is how does it affect your governance? And that means governance at the board level, but very importantly at the management level, and all the controls that go with that. Because I think one thing that is true, based on work that I did in my prior job, is that there is, and Deep, I think you alluded to this, even there is a disparity, there's an asymmetry of knowledge within companies as to where they are in AI. I entirely agree that with, and this is why it doesn't show up as much in the MD&A, is companies are still in the experimentation phase. They're not yet in the full adoption phase. So that's why you see more showing up in risk factors than you see showing up in the MD&A. But even companies' own knowledge of what's going on within their walls about AI varies. So there's a report put out last year that noted that GCs, who are general counsel, who are a lot closer to what's going on in the company, reported a fairly high level of usage of AI. When you got to the CEO, they said, oh, it's a much lower level. When you got to the board, it was lower still. So I'd say the governance around AI, both at board and management level, and all the controls associated with it are another key area. So anyway, I'd say those are sort of 4 areas where companies should be thinking about, and then that then can lend itself to how they tell their story.
But just to be clear,
Yeah.
I took away from your earlier comments that you think it's too soon to try
Yeah.
to standardize
I think the
disclosures.
best. Yeah, exactly. I think it is, because I think what you need to do first, I mean, this is just sort of, I don't know, Corporation 101. You start with what it is we're talking about, then you talk about what you're doing in the area. You know, you think about it internally as a management team, as a board, and then disclosure follows from that. And we're still fairly early on in this whole process. And so I think the main thing that would be helpful, and I don't even know particularly what the SEC's role will be here, other than convening and perhaps discussions, is help companies think through and be more consistent about the questions that companies are thinking about internally when it comes to AI, and making sure that they're covering all the relevant areas, because, you know, they can have blind spots. Oh, we hadn't even thought about that. I mean, if you look at where they're disclosing and risk factors, it's a little bit of a hodgepodge, candidly, right now. And I'm not sure companies actually said, okay, marketplace, workplace, public space, governance. Even if you think about those 4 categories, then you say, okay, maybe we ought to put a little bit more here in governance or something like that. Maybe we put a little bit more here in human capital than we're doing now. So I think actually helping companies think through the range of areas of impact will then lead to more robust disclosure naturally, more tailored to each company. And then you could say, okay, what are the consistent things we're saying? Is there a problem to even solve here?
Could I jump in just real quick? Yeah, I think there is international conversations going on about AI at all levels. And I think the role that the committee and the SEC could play here is to kind of create a node around which there could be discussions. And, you know, whether we have the specificity to provide a detailed framework, or whether there's more of an effort to provide just kind of a point within the overall disclosure framework to say, okay, here's where you need to be thinking about and talking about it. We have seen from the surveys a sense that we're probably should be doing more about this, and the sense from investors like we'd like to know more about this. And so I think creating some point of organization, or a point around which that conversation can happen in this particular framework, would be very useful from a societal perspective.
So what I hear you saying in some ways is start giving us the outline, at least so that we can start filling in. And then eventually, right, we can start thinking about more crystallized things, but we're not even there yet. We're just at figuring out the outline. Is that what I'm hearing?
Sure, Dad.
Okay, no, I just want to make sure. Sorry, that is a little bit of a leading witness, right? Okay, why don't we do this? I will get into the open it up to all the members, because I'm sure there's going to be a lot of great questions, and then and I'll just call on people as they turn their tents up. So let me start with Brian. Brian, you had yours up, and then I'll turn to you next.
Alvin, thank you, and panelists, thank you very much. Your opening remarks were terrific. I've got a number of questions. Let me throw them out, and then I'll tell you where I'd like to start. But one question for you, Professor Bodie, but why don't you think about it while we turn to some others, is the definitional question. You know, you touched on the question, and Paul, you mentioned it as well. You've done some prior work. But I'd like to hear a little bit more about your own specific views on the definitions as opposed to just talking about it generically. What do you think the definition should be? And if you can give me and give the committee some ideas, I think that would be helpful. Hamish, a question for you. You raised the point about the 93 companies with over $1 billion market caps that are at risk and falling into the realm of a WorldCom or Enron. But what you also said, though, which I find interesting, is you don't believe those are false positives. What gives you that confidence? And I'll have you answer that first, but let me throw out one other question for Deep and for Rekha to think about while Hamish talks, and that is, how would you measure the return on investment for AI? I'd like to hear something about that, because that is an important question to investors. If there's going to be disclosure about the amount of money that's being invested, when you have, investors are then going to ask, okay, what is the return on investment? I'd like to hear your views on how you measure that. But Hamish, let me start with you on the false positives.
Sure, thank you. Look, it's a great question. I mean, obviously, it's really critical if you're utilizing any kind of AI machine learning system that not only do you understand how it works, but to your point, that you are assured that it is accurate. For the kind of predictive AI system that I described, I think very broadly speaking, for any system like that, people would take a fairly similar approach. In the instance of this one, essentially, we have a sample of thousands of known companies that have manipulated their accounts over the course of the last 20, 30, 40 years, from filings, from lawsuits, from all manner of different sources, built up a proprietary list of those, and you can provide those to a system to train to look for patterns of behavior in that data that it then learns are associated with some form of malfeasance and ultimately corporate collapse. So now that's all very well. You can do that and train up a system, but then for any statistician in the room, that you can get into the world of overfitting a model. So you can get a model that looks wonderful historically, but it has zero predictive power. So again, I'm grossly simplifying here, but of course, you can just take samples from the data. So, you could, for example, just take data from the 1990s and train your model on that, and then did your data from the 1990s and the model you built on that predict the 2000s, or do the same thing for the 2000s for the 2010. Again, I'm grossly oversimplifying here, but there are plenty of ways to, in a very highly robust manner, and in an academically robust manner, assess the validity of the model itself. Now, in terms of my reference to false positives, there is a flip side to that. So in the context, again, of the kind of system that I described, while it minimizes false positives, the flip side is that therefore it cannot guarantee that it identifies every form of malfeasance. So in other words, it's specifically designed that it doesn't necessarily capture every type. To be honest, it catches a very high proportion, but it doesn't guarantee it catches every type. But with a very high probability, if it says a company is engaged in some form of serious malfeasance, it is with virtual certainty. So there's a trade-off there in terms of those two sides of the two sides of the equation.
Okay, thank you. I'll throw it
Can
out
I
to the
just-
rest of the
can I-
panelists on the other
Can I
questions.
just offer an observation? Because I've, having been in the governance field for 35 years now or something, and having read a whole lot of studies that try to, predict the future based on the past and know the correlation of these characteristics with corporate, with TSR or other metrics. I appreciate what you're saying, Hamish, but I'm also acutely conscious, having sat through 689 board and committee meetings at my last company, the importance of the human element here, and for example, the Dime Savings Bank, where I happened to serve as corporate secretary during the S&L crisis, was rated 5 by the FDIC in danger of imminent seizure. 18 months later, we were rated 1, which is the highest possible rating you can get. We were the only bank in American history that did that. I would have been deeply concerned if a model had predicted our failure and we were not able to raise the capital to recapitalize the institution. So I just offer that as maybe AI would have caught that and said, wow, the quality of the management team, we were led by Dick Parsons, who went on to lead Time Warner, chair of Citigroup, cleaned up CBS. Anyway, he had a whole record of going in and cleaning up messes, right? And maybe that would have been captured, that you had someone who actually knew how to manage a crisis, to deal with the regulators and get you through, but maybe not. So I just want to offer that as a countervailing real-world example to somehow we've got to take into account if we're going to, and this gets to the definition, which I'll hold off on, going to have these semi or rather quite autonomous systems.
And
Yeah, if I can just make one very, very quick point on that. And look, it's a great point to raise. There are serious implications from these systems in terms of if they get something wrong effectively. And what Paul just described is obviously a valid example of that. And as he rightly says, an unusual example. It's unusual to see a company turn around like that. So that is definitely in the minority. But no, I think this is one of the reasons why again, obviously different systems do different things. But in terms of the one that I'm describing, why it's really critical that it has this early warning component to it. So as I say, on average, it can be actually much, much longer, but on average, it's flagging companies as having problems 2, 3, 4 years out from market realization. So I think to Paul's point, this is why it's actually really valuable, for example, for regulators, auditors, big asset managers, banks, et cetera, because it then gives you the time to act. So actually, it then gives you the time to ask the right questions, to investigate further, and to work with the company or the various stakeholders, et cetera, to actually turn the story around. So you're right. It doesn't necessarily guarantee collapse. There is the possibility of turning a story around and actually fixing it. Having said that, once, as we all know, I mean, we've all of us in this room will have seen this multiple times. Once you get to very, very serious levels of some form of corporate malfeasance, it's very, very difficult to fix that without essentially the big bath approach, basically.
I guess I'll quickly jump into this as well, just in case you're short of people arguing this.
Don't worry, I'll jump in very soon to kind of fix that order.
But I think just want to make it, since we're talking definitions, it's very important to remember that AI does not mean one AI. There is not this one, we often think about AI and largely driven by some of the LLM developments and so on as this one entity which knows it all, right? That's not the case. So it's AI which is being developed by a lot of humans in a lot of different places, and transparently could do a great job with one thing, but we would not go and start using it just because the system said so and start seeing that these firms are doing right. At some point in time, we would do it more because you are standing behind it and somebody's convincing why this is the right thing to do, right? So I just want to be super clear that we may have to, and that may be one of the guidances, is that people should stop being in that trap where you say, we will do this because AI said so. There is not an AI, right? It is some humans who are some organizations, some entities that is standing behind the intelligence. And as each firm is developing its own intelligence and its risk monitoring mechanisms and so on, it is the intelligence of that firm. And that's the language in which it has got to talk about it, and it will have to take steps on how you build credibility around it so that people believe in it, right? It will be more than just saying that AI said so or here's a set of stats. It will go into the lot of the underlying processes, the people, how it came to it, is it debatable, is it not, and each firm will have to go through that process. So just wanted to clarify, the human element of it.
Let me jump in here. Thank you for that. And I was going to say that insight brings in another area that I tend to work in, is like the labor and employment relations matter part of things. That's actually a discussion that's very prevalent there, that hasn't been brought regarding AI, that hasn't really been brought into how we think about it in this space, right, in the corporate governance and space. So there's a lot of people around the room who have a lot of interest. So let me just say where I'll go. Jennifer, then James, Christine, and then Andrew. Yeah, there's a lot. So I think we'll probably use up our time just there. Why don't you go ahead, Jennifer, and then, yeah.
So the question I have is kind of taking a step back. To hear the framework that Paul laid out, the kind of four-step framework, that framework sounds to me like something that benefits companies when you're talking about any business process or any business strategy. And what we've been talking about here today is specifically AI disclosures. How is AI different from the investor perspective that we need to be treating it differently from cloud or quantum or the company's adoption of Microsoft Word? What is so different here in the AI context that from an investor perspective it requires different guidance?
I would touch on that a little bit. And, I think when we think about it internally, we don't see it as so different. We see workforce transformation, business transformation. We see disclosures around that apply to AI as well as, in other areas. And so when we're thinking about AI specifically, there's just a lot of attention, a lot of investment, a lot of money being poured into this. And, Brian, to your question on, we're seeing a lot of investment, and so we want to see what is that ROI as well. And, when we're thinking about the ROI on it, we're thinking about cost savings, we're thinking about where, of the transformation, how does this impact sort of the workforce, and how is the workforce being transformed, what is the training, what is going on there. And so we don't see it very fundamentally different from some of the other disclosures that you'd need around other areas. But because there's a lot of attention, a lot of investment in this space, we do think that there could be a call out here.
Just 30 seconds, and it goes to Brian's question. I think what makes it different, it's a great question. What makes it different relates to the definition of AI, which is its degree of autonomy today, right? Because the definition you could use is AI is technology that mimics human thinking and making assumptions, learning, reasoning, problem solving, and predicting and producing content with a relatively high degree of autonomy. And it's the autonomy that I think makes this different. It's like bringing someone brand new, a sort of powerful, respected force into your workforce, into your decision-making process. And it's that, and frankly, what goes with AI, which is different from prior technologies, is this unpredictability and drift in AI systems, right? Because like a person, it drifts, right? And it's like a toddler. It will outsmart, and a teenager now, outsmart any controls you put around it. So I think it's that autonomy that sort of sets AI apart from some of the other technologies that you're talking about. So I think generally that framework, and you're entirely right, the framework outlined works for sustainability, it works for demographic change, it works for anything. But I think what's a little different about AI is the degree of autonomy.
Yeah, and with that autonomy, and the unpredictability, that stochastic element, I think what makes a difference is that you can sit in front of a chatbot and say, make a bullish case for the company, and it will give you a bullish case for the company. You ask me a really bearish case for the company, it will do the same. In the same instance, it can do that as well, right? So when it is independently taking those decisions, the designer may not always be in control of what that output is going to be. That was not the case in the past when the algorithm, even if it was very complex algorithm, but there were few people sitting together and they knew what that output is going to be in different scenarios. That's where but it still doesn't take away from the core business objectives. It may only amplify, speeden up everything. It may do it in a larger scale, but it will still be subordinate to the core business objective.
All right, James?
First off, I'd like to thank each of the panelists. You've been great. This question is for Hamish. In our system, we place a high value on the role of auditors. Why aren't auditors addressing the risks that you mentioned?
Thanks, James. So, actually, really interesting you bring up auditors because obviously that's relevance also for the wider discussion here with regard to disclosures. You know, who monitors those disclosures from the companies? Is this something in AI disclosures or financial disclosures, whatever they may be? But obviously, focus today on AI disclosures. That something that auditors should be looking at? In the context, obviously, of what I was discussing, clearly it's the financial disclosures alone. And the reality is, and I think this
my earbuds just ran out of power. Hopefully you can hear me. Great. Okay. Apologies, my earbuds just ran out of power. So this is a relevance also from the perspective of what the auditors themselves should be doing. Now, auditors are under enormous pressure. People want to pay less audit fees, not more audit fees, and it's a very competitive world. And so, they don't have the ability to do a deep forensic dive. And I think, the Commission should also be conscious of any additional requirement upon auditors to actually be monitoring other forms of disclosure may be problematic in terms of just, what's their capacity to do that above and beyond what they already do. So, the auditors realize that they are seriously resource constrained. There is a limit to what they can do. And as a consequence, that's why, for example, the product that I described is already being used by multiple Big Four auditors for exactly that purpose, because they know it's essentially something they can't cover off with a standard audit process. If they're doing a deep forensic dive on a company, that's a different story, but they can't afford to do a deep forensic dive on every company. The process just doesn't work that way. Thanks for the question, though. Thank you.
Any of the other panelists want to jump in?
Just really quickly, companies are using, if not autonomous AI, they are using technology to both assist and augment their processes. So, for example, companies are using this sort of predictive technology to help them in their compliance programs, identify those areas that are at most risk, and sometimes internal audit is using this sort of technology as well. So it's not full-on current AI, but they are using technology to help them. So it's a great point, and I do think you can achieve significant efficiencies by using these sort of technologies.
Okay. Christine?
I think my question starts with Professor Bodie. You talked a little bit about the cybersecurity disclosure item as potentially being a model, at least from a definitional standpoint. Will that work as a model for AI disclosure more generally? Or would AI disclosure, given its overlap with a number of different existing disclosure items, be better integrated into the disclosure? Or would a better approach be guidance as to how AI might already need to be disclosed under the existing disclosure items?
Right. It is different from cybersecurity threats and cybersecurity protections. That is a more cabined set of risks. It is related, obviously, to AI, because use of AI can increase your cybersecurity risk. But I think the question would be, do you want to use the existing framework and highlight how AI has changed the conversation? Or do you want to break it out and say, okay, this is a special area of concern, but also a special area of opportunity that should be discussed specifically because it's something that a lot of folks feel is not being addressed, within particular companies in a particular framework. So I do think that it is unique enough. In some ways, it is more like human capital in terms of the question about how it is defined, how is it used within the company, what are the risks that are generated by it. But I think for the committee would be a good sense of trying to figure out, can it be defined? How will it be defined? Right? I mean, it is very difficult to define, right? We're close to the Supreme Court. I'm kind of reminded of Justice Potter Stewart's, I know it when I see it about something else. But at the same time, people are using it to mean something, right? It's in the conversation because people have an idea of what it is. So I think articulating a definition of it is an important step and something that I think, definitely the committee could take on just as a way of kind of highlighting what is and what is not and what is different about it in a way that my former panel articulated it really nicely in terms of the autonomy and to some extent the uncertainty that can come with the use of certain models.
All right, Andrew and then George, and then I'll wrap us up.
Yeah, as we think about the framework and and what kind of constitutes materiality when it comes to AI, when we talk about workforce transformation, there's obviously been some good thinking about productivity and how that affects the optimal employment levels. And so maybe I'm thinking about, I'm trying to understand how the panel is thinking about, one other type of instance where, are there concerns that with the increasing use of AI, that there is the potential for a degradation of institutional knowledge? And the reason why I ask that is because, Paul, you mentioned about potential blind spots in this analysis. So I'd be curious, is this more material? Is that more strategy? And then also, going upon, Deep's point too about the next generation really starting to rely increasingly on generative AI, right? How does that kind of, and also with Professor Bodie's comments about this systemic over-reliance potentially on different systems. So, how does the panel think about these types of issues in terms of just, again, within an institution from one generation to another, of how institutional knowledge is passed down, understood, and implemented? How does the panel think about that as a potential risk?
I'll just say quickly, that is a really big risk. And I was just thinking about it in terms of the recent Writers Guild strike and the relationship that Hollywood has with AI, and a real concern that since AI is based on what we've done in the past, it will really limit creativity going forward, and it might be seen as a cheap way of developing a script that meets certain metrics and really reflects what people have done in the past in kind of a way that we wouldn't have expected, 5 years ago. But it could really potentially stagnate that particular industry if you're just building on what you've done in the past. So I think that's a really important consideration.
I would concur that it's a pretty important consideration, given that there's a lot of focus on sort of the training employees to use these tools, but then maybe training around the sorts of institutional knowledge, and keeping that around, like that's less focused on, especially as folks are eager to kind of adopt tools. And so I think we think about it more in terms of how are you thinking about training, what's your investment there, and across the board, like where is it going? And because it is a pretty significant risk.
I think it's a very important question for sure, partly because we really don't know where the arc of this goes. There have been, say for example, when the AI came into picture, there was this perception that it will start reducing the gap between the top and the bottom performers, right? Because newcomers come in, and there were some experiments on that it can really come in and start quickly closing the gap. Of late, a couple of papers have come out, including one from University of Chicago, I believe, which talk the other way around, that sometimes it actually, when the same investment information through AI was presented to more skilled investors versus less skilled investors, it actually broadened their gap. So it can be used to, so there are ways by which it can shrink, there are ways by which those gaps may broaden. There are ways by which the institutional knowledge may collapse into one single entity. There are other in which it may actually help. We also find that it may reduce the silos. So there is a lot of that institutional knowledge that stays in silos with people and does not really become fully institutionalized within the same firm. And it actually helps also reduce that. So these are going to be a lot of moving parts. So I don't have an answer. I do want to point out that that focus and being able to constantly think about it as this evolves and kind of manifests itself, it will be important that yes, we are staying on top of it. But I don't think you have. It's straightforward to say that it is unidirectional.
Just a quick comment. I agree with you. It's a significant risk. There's also an opportunity here, right? To the extent that you're making more recordings of what happens in meetings and so forth, and then that's now accessible through AI. You can actually enhance your ability to access institutional knowledge, but what is clearly missing from AI is the human judgment, and frankly, there is no EQ in AI right now, right? And so knowing how some of this stuff went over actually is something that only people can manage right now.
George?
Thanks to all the panelists for this really illuminating discussion. And since we're close to out of time, I'll keep my comments brief. So I have two questions, perhaps mostly for Matt and for Paul, but the other panelists may have insights as well. I wonder whether, in addition to the degree of autonomy, the level of hype surrounding AI is one of the differentiating factors. So when blockchain and crypto first came out, we saw examples of companies just adding the name blockchain, leading to significant in like Long Island, Ice-T started saying that they were going to focus on blockchain, and that actually increased its stock price. And I think we're seeing some of that with AI as well in a more pervasive way, and also in a way that isn't going to just fix itself, right? The potential for misvaluation, which I think goes to the interests of investors in a very fundamental way. So the hype factor is one question. Then the other question, this is something that Matt alluded to in the beginning of his remarks, is to what extent can we think of the SEC's human capital management disclosure rule from 2020 as an example or as a model of the approach that can be taken here? Because that was a very open-ended rule, and it generated a lot of disclosures of information that arguably was material even before, and the rule was conditioned on materiality, and this information was material even before. If it was material after September 2020, it was presumably material just before September 2020 as well, but it generated a lot of new disclosures, and I know that, Paul, you've done a lot of work on that as well, so I'll pause here.
Just quickly, I think guidance on immateriality and hype, AI washing, right? It's one thing that has been singled out from the comments from the staff on disclosures, and certainly something that could, again, help cut through some of the noise, perhaps, generated by AI. And I know your work, Professor Georgiev, has talked about some of the shortcomings of a principle-based approach with regard to human capital management, and that would be something I think for the committee to consider in terms of balancing out the idea that you do want flexibility, you want the ability to change over time, but you also want to provide some degree of, outline or framework that people can use to allow for comparison, right? Because obviously one of the big upshots certainly is the ability to compare between companies and to assess what one company is doing versus another as an investor, and that becomes more difficult the more fungible or the more inchoate the disclosure is overall.
So let me jump in here because we're at time, and I just want to highlight a kind of a sentence that I saw in this abstract from my colleague at the Kelley School of Business, Ryan Johnson. Thank you, Paul, for sending this along to me. At the end of his abstract, he says, as AI adoption accelerates, distinguishing between genuine AI integration, right, because we've been talking a lot about operations here, and strategic misrepresentation will be critical for investors, regulators, and policymakers assessing firm value and the broader economic impact of AI. I started and kind of thought about this panel and said we need clarity, whether there's a principles-based approach, more strict rules, or something in between. Where I want to land on this is give me literally one sentence on what is the number one thing you would want to see addressed in a recommendation as far as an item regarding AI, just to wrap it up and bring it to a close. And so let me just go from deep and work down to, I was about to say James, sorry, to Professor Bodie. From deep, and then after Professor Bodie, Hamish. Thank you.
At this stage, creating that guidance which we talked about on how to think about AI and how to talk about it within the framework of your company's strategy, and what company metrics are you enabling it to move should be the encouragement. And once again, as a guidance, would be the best thing to do at this stage.
One sentence is hard, but no, but I think as businesses are transforming, as there's business transformation, workforce transformation, the metrics and the information that can contextualize the progress or process for investors is really important to have. And it's something that companies need to be guided along in terms of what that can look like.
I agree with Deep as to where we are right now and what would be the most useful approach. And I like the idea of the SEC sort of helping to serve as a node for thinking about this, which may lead to, disclosure changes in disclosure down the road. But I think serving as a thought node is a great place for the SEC to be right now.
Yeah, just in terms of the ramifications of AI for the business model, for the human capital at the company, for investor risk, I think is basically how I would frame it.
For me, the key thing I would mention is consultation. So I mentioned I'm sitting in Singapore. Singapore has a national AI strategy. The government is putting enormous effort into consultation, education, funding around this. And I'm actively involved in one of those projects. There is very, very deep engagement between the government, various aspects of a whole raft of, in fact, really the entire government and every regulatory body you can think of, consulting in depth with industry as well. I think it is really critical. It comes back to that point that made before by others that we're in a very fast-moving space. It's very difficult to be prescriptive. This is an extremely challenging area, therefore, for government and for regulators to deal with. So I think that consultation is absolutely critical.
I want to thank everyone for the effort put into this, and I hope it was a fruitful discussion. Thank you.
That concludes our question and answer session for this morning. I want to thank all of our panelists and participants for their insights and productive discussion. I want to thank Alvin, Christine, James. I think there are a host of others, Craig, everyone who worked on this panel. Thank you all for your time and effort. We're now going to adjourn for lunch and an IAC executive session. The public segment of this meeting will resume at 1:45. We'll begin with remarks from Acting Chairman Ueda, followed by our afternoon panel, and then a discussion of a recommendation and a series of reports from our subcommittees. Thank you all very much.